15 topic of discussion. Please subscribe to my YouTube channel for more content on personal finance and investment. Why don't stockbrokers ever run out of pencils? Because they always know where to draw the line. Now let's shift our focus from stockbrokers to a different breed of financial wizards, those in the world of peer-to-peer lending. In the vast expanse of the financial universe, there's a relatively new star that has been steadily gaining brightness. It's called peer-to-peer lending, or P2P lending for short. And no, it's not a new dance move, but it is shaking up the world of finance in a big way. So what is peer-to-peer lending? Well, in simplest terms, it's a way for people to lend and borrow money directly from each other, without the need of a traditional bank acting as the middleman. Think of it like a financial dating app, matching lenders with borrowers based on their preferences and risk profiles. This method of lending and borrowing is becoming increasingly popular, and for good reason. It offers a refreshing alternative to traditional banking systems, where the terms are usually set in stone and the process can be as slow as a snail racing uphill. With peer-to-peer lending, individuals have the power to set their own terms, and the process is often quicker and more efficient. The shift from traditional banks to peer-to-peer lending has been driven by several factors. One of the main reasons is the potential for higher returns for lenders and lower interest rates for borrowers. Another is the increased transparency and control that P2P platforms offer. In this digital era, the concept of eliminating the middleman in financial transactions is not only appealing, but it's becoming the norm. By connecting lenders and borrowers directly, peer-to-peer lending offers a more streamlined and democratic approach to finance. It's a bit like cutting out the financial middleman and giving power back to the people, one loan at a time. So, as we can see, peer-to-peer lending is reshaping the landscape of financial transactions, but what exactly does it entail? Imagine a world where you can lend or borrow money without setting foot in a bank. Welcome to the world of peer-to-peer lending. Peer-to-peer lending, or P2P for short, is a system where individuals can lend and borrow money directly from each other, completely bypassing the traditional financial institutions. It's like online dating for your wallet, matching lenders with borrowers in a secure and transparent environment. Let's start with the borrower's perspective. If you wanted to borrow money through a P2P platform, you'd first need to fill out an application online. This would typically include information about your credit history, income, and the purpose of the loan. The platform then evaluates your creditworthiness, sets an interest rate, and posts your request for lenders to see. Now let's flip the coin and look at it from the lender's perspective. As a lender, you'd start by creating an account on a P2P platform. You'd then browse through the list of loan requests, reviewing each borrower's credit score, interest rate, and loan purpose. If you find a loan request that fits your risk tolerance and investment goals, you can choose to fund it, either partially or in full. So, where does the P2P platform fit into all of this? These platforms serve as the middlemen, facilitating the transactions between borrowers and lenders. They handle the loan origination, repayment scheduling, and collection processes. And for their services, they charge a fee, usually a percentage of the loan amount or the interest payments. But what happens if a borrower defaults on their loan? Well, the platforms have measures in place to protect lenders, such as debt collection procedures and reserve funds. However, it's important to remember that just like any other investment, P2P lending is not without risks. With the digital revolution, borrowing and lending money has never been easier. But like everything else in life, it comes with its fair share of risks. You know what they say about money, easy come, easy go. But with peer-to-peer lending, what are the risks and rewards involved? Well, let's dive right into it. Starting with the rewards, one of the significant benefits of peer-to-peer lending is the potential for higher returns for lenders. Traditional banking institutions often offer interest rates that can barely keep up with inflation. But in the peer-to-peer lending world, the story is quite different. Lenders can often enjoy returns that significantly outpace inflation, making it a potentially profitable venture. On the flip side, borrowers can also benefit from lower interest rates than those typically offered by traditional banks. This win-win situation makes peer-to-peer lending an attractive option for both lenders and borrowers, creating a financial symbiosis that can be mutually beneficial. Now, on to the risks. As the saying goes, higher reward often comes with higher risk. And it's no different in peer-to-peer lending. The biggest risk is defaults. Unlike banks, which have the resources to chase defaulters, individual lenders may not have the same kind of financial muscle. This means that if a borrower defaults, the lender might have a hard time getting their money back. Moreover, peer-to-peer lending platforms do not have the same level of insurance as traditional banks. So if something goes awry, there's no safety net to fall back on. This lack of insurance can make peer-to-peer lending a riskier proposition compared to traditional banking. That's why risk assessment is critical when it comes to peer-to-peer lending. It's essential to scrutinize the credibility of borrowers and only lend what you can afford to lose. It's always wise to remember that while the potential rewards are high, the risks can be equally significant. So, while peer-to-peer lending can be a lucrative venture, it's crucial to tread carefully and assess the risks involved. Like any investment, due diligence is key. After all,